what I also want to discuss here is we had a YouTube comment back and forth with David T. And David had mentioned a back and forth on some of the recent video that we had. He says, "Thank you. You make great content." Well, thank you, David. I appreciate that. So is there a rule you usually stick to in terms of time frame for a debit spread yourself? And he was asking about one of the recent credit spread discussions that we've had. Now, I was going to answer David with similar links to the Bull Put Credit Spread playlist and the Bull Call Debit Spread playlist. Show him a link to maybe 8 videos where we discuss the comparisons between and then what we decide to do. But I figure I just prefer to use a quick review here. David, you're asking specifically about debit spreads. I'm going to jump the shark a little bit, for lack of a better term. And I'm actually going to go just to Bull Put Credit Spreads. Let's go ahead and go back to Power Options. In the Bull Put Credit Spreads search, like we just saw in Ram's discussion for the criteria using for long calls and long puts, and we just talked about the trade picks of the day, and I mentioned the Bull Put weekly expirations and monthly expirations. This weekly expiration is based on the default criteria that we have under Bull Put Credit Spread, weekly picks of the day. But it's shown in the search as well. And my preferred default search, weekly Bull Put Credit Spreads, when I am doing a credit spread, bear or bull, following the market sentiment tool and power options, the bear call credit spreads have the weekly bear calls as well. This is the criteria I prefer to use. I'm looking 2 weeks out in time, 8 to 17 days out in time. Minimum 9% return, 20-cent net credit, at least 3% out of the money, but on average, they're about 6 or 7%, 5 to 6%. And I'm looking for a probability above of greater than 85%. This does relate to the delta, which you can search for short option delta or delta ratio as well in our search tool for the options criteria, as you can for most strategies. But I prefer to use the probability. It will an 85% probability above will translate roughly into a short option delta for your sold put, in this case of negative 0.15, negative 0.14, negative 0.16, somewhere in that range. Now, in the technicals, I'm also looking for similar things, stocks trading above a 20-day moving average and stocks that have a positive MACD cross signal at least over 3 days, where the MACD has crossed the signal line for at least 3 days with more of a confirmed uptrend. This typically represents about 15% of my trading portfolio, David. So when I'm going credit spreads, I'm going high probability, 85, 85, 86, 86%. As I mentioned, you see the short option delta, negative 0.13, negative 0.12. I'm looking for the 9% return minimum, but on average, I'm seeing about this range, a 15 to 15.1% return on the winners and a 49 or so % loss on the losers. Why? Because I'm using management techniques to control that. I won't allow myself to take more than a 50% loss on a credit spread, bull or bear, because then that's going to get you into the lie of leverage. You can say that credit spreads are low risk. Well, they are, but only if you trade them a certain way, with a limited portion of your portfolio and you're disciplined in the contract size. You can also say that, Mike, what are you doing? Here you've got Celestica, volatile stock at about 120. It's about 119. I'm going to sell a 105 put and buy a 103 for 160. I'm sorry, my apologies, for 40 cents, but you're risking 160. This is about a 4 to 1, 5 to 1 risk-reward ratio. Let's see, what's the worst one in here? 155 to 85. So we're looking about a 7 to 1 risk-reward ratio here on app loving. Why would you do that? You're never going to make money. Well, I never allow this full loss to occur. And it's possible to do. And I've tested this criteria. I've used this criteria. I've traded this criteria and run other examples during different implied volatility times, adjusting some criteria from here to there. Market sell warnings, market buy warnings with our market sentiment tool. But even in a sudden market shift, even with the market shift we saw in April, I didn't have any bull puts open. I had some bull call debit spreads open, but I was able to close those out even with the market downturn to only see a loss of maybe 380 $4, $4.20 on this position. So the risk is still 4-1. But on average, what I'm seeing, as I mentioned, is close to that 15% return, using about 3 to 4 trades per cycle on the winners, 49% loss on the losers, and the success rate is about 87% over time. If you allow this winners to go too much, or if you close this when you get 50% winners, and I start closing these when I get a 7.5% gain, I throw this ratio off, and that's going to cause my trading plan. But to your question, David, time frame wise with credit spreads, I prefer out of the money, high probability, low delta on the short option, looking for double-digit returns. But yes, I am taking a 5-1, 6-1, 7-1 risk-reward ratio, but I have management techniques in place. I'm avoiding earnings. That's another filter I should mention. I'm avoiding earnings between now and expiration on these positions. This is sort of the trend I've been looking for. This is what I look for in these positions. Celestica, yeah, you could say it's overbought. We're near, yeah, we are. We're not too near it. The 52-week range is 144. Celestica still has maybe some room to run in this situation. And it matches the criteria currently. Okay, back to our discussion on SPY. Let's go ahead and take a look here. Remember, we said May 19th was the peak. And the last 4 days, we've pulled back. So let's go to backtest. Let's go to Smart History Excel. I don't know the results of this. I might get pie in my face, for lack of a better term. But let's go to May 19th. And, you know, I'm using 2 weeks out, about 11 days out. So with only 4 days in, I still have a week to go. Let's get our default search, weekly bull puts, and go ahead and submit that. Now, I apologize. At this moment, it's going to take some time. What's happening right now is that we are downloading all of today's data into the historical search tool. It happens around between 4:45 to 5:15 p.m. Eastern time. I know it glitches us on the Friday webinar. It's not a glitch, but right now the system is interacting with our historical data tables. It's well over a terabyte of historical data. And while new numbers are being plugged in, we requested a search to go in and find it. We saw the search earlier for the long calls and long puts snapped right in. Right now, though, this is taking a little bit of time. I apologize for that. It's going to come up in a moment. Okay, maybe not. But while we're waiting for that to pop up, let's just go over here real quick. I'm just going to mention something real quick. We are going to talk about debit spreads there, so don't worry about that. Okay, there we go. So let's see here. Fantastic. Here are our results. First Solar, Vertiv, Caterpillar, Vistra Seagate. I probably would have taken the top 3 or 4. I would have researched and analyzed these, but I would have taken the top 3 or 4 of my list. Would I be at any profit right now? As we saw, SPY was hit the peak on May 19th. We've pulled back since then. Now we got to calculate the group results. Now I know it's only 4 days in. 3M is in there. That's interesting too. Palantir was up there. We saw those movements. All right. So the first one, yeah, I'm at a loss of 21.5%. GEV was at 446. We sold the 30th of May, 400 strike, bought the 397.5. The stock has dropped to 464.39. Stock is up to 464.39. This should be showing a profit, but it is a loss probably due to bid-ask spread. Currently, we could liquidate the First Solar 164, 158. We've got some time value decay. It's at a 16% return. And even Vertiv, the 96.94, the stock's at 104.14, pulled back. We could liquidate now for a 9.5% return. All right, so we're only at 50% of the winners and losers, but most of these are still out of the money. 335 strike, 343 here, and we've got time to go. ARM at 127, down from 132, but we're holding the 118, 116, and we have an extra day of time value decay in our favor. So these, I know right now, only 4 days in, these are doing what I want. Let's go back. I want to check something real quick here. Let's look at a bad time period. And I know I'm going to shoot myself in the foot on this one too. So, okay, you say, Mike, you know, you're not at 100% success rate. You're losing money here on this. You're down 7.6% if you opened all of these positions. and it's only a 50% return. Yeah, we're only 3 days, but I would defend that, excuse me, my apologies, by saying we're only 4 days in. And although I'm seeing losses here, okay, BX, you got me. 145, 45, 137, 135. Strike is at 136. That would be perfect for a pendulum adjustment. Someone remind me to come back to this one. BX, bull put on the 19th. But most of the rest of these are still out of the money, even though they're showing losses. So I'm right where I want to be in these positions. And in a week, next Friday, I'm going to check this as well. We're going to review what happened here with the weekly bull puts to see what happened. Whatever the market does, we're going to review to see what happens. All right. So that's credit spreads. That's what I prefer. And I'm not going to go into the other tests now. We're going to save that for another conversation because I want to get closer to David's situations. Now, those are my preferences for credit spreads because remember, you're selling an out-of-the-money put. You're selling a put, in this case, that's out of the money, and you're buying one that's lower. So your risk is between the strike prices of the trade. That's your maximum risk. You have an obligation in a credit spread. If the stock falls, as we just saw with BX, I have to deliver shares of stock I don't own at 137, with the stock now down to 136. My 135 put protection, quote unquote, hasn't clicked in yet. So I'm sort of naked in that view. With a debit spread, you're not. In a bear put debit spread, I'm still selling a put, but I'm buying a put at a higher strike price. I'm paying a debit, but I'm protected. So even if I get assigned early, that long put's going to be activated. Same with the bull call debit spread. Let's add those strategies in because I don't have them right now. We have bull call debit and bear put debit. Not used as frequently. Credit spreads are used more often, but that's fine. It's still used frequently. Let's go ahead and save that configuration. Now, just like any other strategy we talked about, in a bull call debit, we have the same risk-reward profile as a bull put credit spread. It's a parity trade if you use the same strikes and the same expiration. And if I go into the main search, I have some views here. We have the initial values. This is looking for in-the-money bull call debit spreads, has more than 600 results. So let's just go ahead and up our return. Whenever you see that note that it's more than 600 results on a default search, just increase the probability or increase the return a little bit. I'll increase the probability to 75. Hey, if I'm happy with 9%, I'm going to be happy with that. So now we get some positions here. These are the shorter term ones. They're a month out, but they're 50-cent strike differences that are showing high returns. But the default criteria I wanted to talk with you, David, for a debit spread, this is just some of our defaults. Bull call debit, number one. Bull call debit with leaps options. Initial values, and yes, there is a weekly bull call debit spread search. Looking at similar criteria that I use for the bull puts. Minimum return 10%, probability greater than 75 or 80%, avoiding earnings between now and expiration, stock price above the 50-day moving average. Not as technically derived, but it's a basic weekly search that you can use. When I use debit spreads, I tend to use a longer term screen, which, if I'm not mistaken, someone correct me. About 6 or 7 years ago, this idea of using at or out of the money bull call debit spreads, 45 to 60 days out in time, was made popular by, I think, Tom Sosnoff at Tasty Trade and Tasty Works. And at first, we ran some comparisons. We had some webinar discussions on this. We compared our weekly bull puts compared to doing bull puts in that fashion. By the way, what I'm talking about with this at the money, out in time spread, only do with debit spreads, never do with a credit spread. But we have a preferred search here in the sample searches, out in time bull call debit spreads. You see here we're looking for things that are 84, 147, 119 days out in time. Stock Charles Schwab at 87.40. We're going to sell the 87.50 call right at the money, and we're going to buy an 85. And we're seeing these huge returns of 50, 100, 110. What is this? This is a 2.5 point spread. And when I'm in a debit spread, The maximum profit I get here, sold the 87.5, bought the 85. Now it is at expiration, 119 days away. But if the stock's above 87.5, my sold call is in the money, which obligates me to deliver shares of stock I don't own. But I own the 85. So if this was at a near-term expiration, the stock was at 88, I had this spread. My broker essentially buys shares of stock at 85, sells them at 87.50. I get 250 back. But my debit was only 147, 148. So I'm essentially making $1.02, $102.50 against a risk of 147.40. That's a 70% return. Now you only have a 50% probability, 45% probability of getting assigned on this position because it's at or slightly out of the money. The concept that became popular with this approach, again, I'm going to give credit to Tasty Trade, Tasty Works, Tom Sosnoff, maybe even Mike with his whiteboard. I can't remember who started this idea. And then others duplicated it. I had to discuss it compared to my preferred strategies. But this is a valid strategy. But what you do in this approach, and I think, if I'm not mistaken, the Tasty Trade approach might only be 45 to 60 days out in time. That's fine too. You're giving yourself more time for the stock to move in your desired direction. But when it does move in your desired direction, you don't hold it all the way to expiration to try and get the maximum profit. You liquidate this spread when you get 50% of the max expected profit. So if I had a profit of 50 cents or 51 cents, I would close this position, whether it happens in a week, 2 weeks, or 21 days. At the same time, I know my debit up front. I'm looking at more of a one-to-one risk-reward ratio. This is what appeals to investors, apart from, David, the bull put credit spreads I mentioned I prefer to use, where we saw 5-to-1, 6-to-1, 7-to-1 risk-reward ratio. So you can never make money like that on an 8-to-1 risk-reward ratio, even if you're right 80% of the time. Yeah, because management's involved. There's no fire and forget trading plan. Okay, there really isn't a fire and forget strategy. There's a couple we've discussed close to it. But management is always necessary, especially with these leveraged spread trades, because you can't allow 100% loss on those trades. I can't lose this 147 because then what am I doing? Okay, I had closer to a one-to-one risk-reward ratio, so I only wiped out 1 or 1.5 trades in this case. But you can't allow that. This approach is using liquidate at 50% profit and close if you're at 50% of the maximum loss, keeping that one-to-one risk-reward ratio. And the concept is bull or bear, following the market sentiment tool and following other market directions, you'll be able to have much greater than a 50%. I don't think you're going to be at the success rate of 87% where I am with my bull put credit spreads that are out of the money, or potentially the bear calls in the right market conditions. But almost a one-to-one risk-reward ratio, success rate of 60, 65%, that's what you look for. So what I tend to do, I'm going to go back to the main home tab. My apologies, David. Following the market sentiment tool, and I'm just going to click on the sentiment history. This is a broad-based knowledge of 13 different indicators that Ernie researched. He started out with, I think, 75 or 80 indicators, narrowed it down to 13, which showed a better early warning of a market shift, bullish or bearish. And looking at those rates of those 13 that he selected, he was able to sell fences was when we're in a bearish range here. What do I mean by bearish range? Well, this is the histogram of the history back, I think, to about 2008, 2009 of the individual occurrences of the put-call volume ratio across all optionable stocks. We're seeing bearish here, and it's bearish when it's below 0.6 on the put-call volume ratio. We've been in a market upturn. Things are optimistic. Now we're seeing some people start buying more puts than calls. It's leaning towards that way, and the market's been pulling back. But why is it at 0.6? Because very infrequently, historically, does it go down to these ranges. It could slip further. It could continue down. But history shows it wants to gravitate back to this area. So if the put call volume ratio starts going from 0.6 to 0.65 to 0.7, what does that mean? It means now more people are starting to buy calls. I'm sorry, are starting to buy puts. We're reversing back. But again, if the put call volume ratio goes up close to 1, where it's a 1-to-1 average, very infrequently does it go higher than that. Which means what? That would be the bullish indicator because we're near a market bottom. People are starting to buy calls, speculated on it moving back up. Right now, people are buying more puts, right? We're at that threshold of 0.6 in this case. So higher put volume to the call volume. I'm sorry, I said that wrong again, didn't I? People are speculating that the market's moving up. They're buying more calls, so this is skewed to their favor, which is usually an indicator. It's a contrarian indicator is what I'm trying to say. But when we go this side, when it gets closer to 1-to-1, it's got to revert back to the mean, back to 0.6 in that case. All right. But David, where am I going with this? You can see the details for each one of those, the histogram for each one of those, as well as the history itself. But you can see the overall sentiment history. So when we have a certain number of indicators go into their buy fences, as we did on what, April 17th, April 21st, and so forth. When? Oh, you know, just about in this time frame, when SPY was down at the bottom. That's where we started seeing these buy signals and these strong buy warnings. That's when I started, oh, sorry, folks. That's when I started jumping back into, that was over here, right? That was in this section, seeing this plummet down. That's when I started getting back into bull put credit spreads, and we've been doing well. Now, new cycle approaches. We've been up. Some things have started to enter into the sell warnings a little while ago. So back in this time frame around May 13th, I still had some bull puts open. We talked about this on, it was before May 13th. I apologize. It was on our webinar on the 9th. One of the segments of our webinars on the 9th. I talked about buying to close my open bull put credit spreads that were at a profit, not necessarily holding them to expiration, and looking to do bear put debit spreads using that sample search, the out of money, out in time bear put debit spreads. And as I mentioned, that was on the webinar on 5/9. And oh shoot, sorry about that, folks. Let me go back to the market sentiment. Oh wait, do I still have it here? No, I don't. Okay, sorry. There we go. I want to look at sentiment history again. Yeah, it was on our webinar on May 9th, if I'm not mistaken. Yeah, May 9th. So let's use that as an example. We're going to go back test on bear put debit spreads, Smart History Excel. May 9th, started to see the sell warnings, closing out some of the profitable bull put credit spreads, and moving into, out in time debit spreads. I saved this on my search tool for the historical testing purposes, David, from the sample search. So when you run the sample search, it's just like the search tool. Let me show that real quick while that's going to load for us. So here I am in bear put debit. I go to sample searches. I go to out in time bear put debit spreads. Again, I'm 147. You can customize. You want to go shorter term, that's fine. You want to go 20. I would suggest going at least 45, 50, 60 days at a time. You want to go 30 to 60 days, that's fine. You can make that adjustment as well. But once I'm in this view, I can go ahead. This is a sample search, not the main search tool, but I can submit the search. Just click that. Now I'm right back in the search tool. And now I can choose to save this. And as we did before, as I mentioned, we just saved it out in time. Bear, Mike, bear put debits. So now anytime I go into the search, I can look at the weeklies if I want that default screen, or I can look at these out in the time bear put debit spreads. When I see the market sentiment turn, I usually like to use this farther out in time for my debit spreads, that 1-to-1 ratio. Following those ideas, again, I don't know if he's going to get mad at me for saying this, but some of those basic concepts, not the full concepts, of Tasty Trade, Tasty Works, Tom Sosnoff and his team about these out in time 1-to-1 risk-reward ratio, close to 1-to-1 risk-reward ratio debit spreads, but closing with a 50% return. Or a 50% loss. So here are our results. We had PBF, WHR, SWKS. I should have limited this to one result per security. I'm going to do that. That's a good reminder. I need to do that. But let's go ahead and calculate the group results here. You know, so we have a lot of positions. Skyworks, I think, is actually stronger. Moderna, wow. I have not been following Moderna at all. How the mighty have fallen, right? Down to 24.25. Jeez. I'm sure there's a split involved there. I hope there was a split involved in there, but it might have been straight down. Theory, AAP, Advanced Auto Parts, and SWK. Skyworks is an old buried put I used to trade. Did pretty well with that one. AEO, American Eagle. Yeah, retailers are getting hurt a little bit. And, of course, WHR Whirlpool. Be interesting to see they do. So we're just waiting for the results to show up. What did we do again? May 9th. When I saw the sell warnings appear, we ran the out in time bear put debit spread search. When we saw the sell warnings appear. And I know the system is fighting itself right now because we have so much historical data being dumped into the tables. It's almost done, I assume. But again, for credit spreads, while we're here, let's review real quick. For credit spreads, weekly picks of the day, that's based on my preferred default search for weekly bull puts. And you'll see the same thing in bear calls, so it doesn't have a separate weekly picks of the day for the bear call credit spreads. When I do debit spreads, I prefer this structure, David, of more of a 1-to-1 risk-reward ratio, looking to close the position if I hit 50% of the maximum profit or 50% of the maximum loss in the wrong time frames, or a market fake out, which happens a lot in these market-driven, news-driven markets. I apologize, ladies and gentlemen. And any day we could be in the great trend we want, and then, oh, here you go, flip. We're going to do something here, and we're going to throw this into flux and implied volatility. The VIX is going to spike. VIX is moving back up again. And yeah, so we have to deal with that as well. But that's what I look for. And of course, you can always see more of that information as we discussed before under the YouTube playlists, Bull Call Debit Spreads, Tools, Structure, Criteria, and more. View full playlist. Review, a look at in the money bull call debits, parity trades to the out of the money bull call debits. In the money versus out of the money bull call debits. Bull call debit or bull put credit. This is another video where I discuss exactly what we just walked through, sort of the discussion on if I opened a credit spread, it'd be shorter term, out of the money, high probability. If I open a debit spread, let's try that again. It errored on me, so let's go ahead and try that again. All right. But yes, with the debit spreads, I'm going to prefer to look for this 30, 40, 50 day out in time spread to give the market more time to move in the direction if the market sentiment changes on me. Usually I'm changing between bull put credits, my shorter term 14-day trades, 11-day trades really, to the 30, 45, 50, 60 days or more bear put debit spreads, but then closing them following those ideas. 7 ways to manage a bull call debit spread, clarifying stops that I would use on a debit spread, and portfolio allocation, very important, because these positions you say, oh, they're low risk. They're known risk. You're risking 100% of what you invest in a debit spread or 100% of the maximum risk on the credit spread. Rolling a successful bull call debit spread, rolling an in the money bull call debit, adjusting for more profits. Different presentations there as we talked about. Introduction, strategy, criteria preference, time frame preference, comparison, management, adjustments, increasing profits, managing a loss as well. And if I'm not mistaken, you have the same thing on the bear put debit spreads. I have bear call credit spreads. Oh, there it is, bear put debit spreads. Similar content in the playlist. Debit spreads versus credit spreads, bear put, pros and cons of in the money debit spreads. Stops on debit spreads, 7 ways to manage, closing profitable, and so forth. Bear put debit as a market hedge, using bear put debits on SPY, QQQ, NASDAQ, SPX, maybe even the Russell or IWM. We walk through comparisons of just buying a put compared to a bear put debit spread, calls on the VIX, other market hedge techniques. That's always a great one to look at. All right, now this isn't giving me what I want, and I apologize for that. We might have to revisit this later on. So May 9th, bear put OTM results. When we saw the market sentiment turn, it looks like it's going to error its timing out because we're updating the historical tables from today's data. I apologize for that. It's been churning. It errored once. Now it's churning again. It's probably going to error again. So I'm going to get you guys those results this weekend. I'm going to add it at this moment, ladies and gentlemen. We're going to break and we're going to show the results of that. I'm putting that in as a disclaimer there, a time marker for me, so I can add that in and talk over it. And we'll see that when I post this segment of the video presentation, David, later this weekend.